Now, the NIC 20, as I said, falling to another 2011 closing low of 3,476 points, despite the positive sentiment that we see filtering through in global markets. Banks noticeably on the losing end yesterday, similar to what we're seeing in Nigeria. Banking stocks also taking a beating there. Why do you see investors particularly selling off banking stocks?
Well, sentiment in the market as a whole is still low. I think we could see that in how the British American IPO turned out. And I think that seeing that we have increasing political risk at the moment, we've been hit by inflation, monetary policy is still quite uncertain. We have so many things that are hitting our economy, although at the same time I continue to see a mismatch between fundamentals and the actual behavior of the market, which is why I'm blaming it on sentiment, because as you can see, most companies are still announcing growth in profits, which is a positive factor. We are seeing banks continue to increase their loan books, which again is another positive factor, because it means that people are still borrowing, and that means that there is still a high level of investment.
That's, an interesting point there you make, especially when it comes to the banks, because many say that they've got the most reliable, predictable income streams when it comes to stocks, the listed stocks. KCB sitting at 20 shillings, a trailing PE of 7.2 at this stage, a second most actively traded stock yesterday. But if you look at its first half numbers, a 41.5% growth in a profit after tax there. Is this time to be buying into KCB? I mean, all the fundamentals are pointing to a stock that's severely discounted.
Well, yeah, my feeling is that this is a time to be getting into the market. Unfortunately, our market has a very pronounced hard mentality or hard effect when it comes to the individual or retail investors especially. So what you usually see is, as the market picks up and as it gets to higher highs, we tend to see very high activity. And when we are at lows, which is a point at which we are in a buyer's market, investors tend to keep away from the market. I do not understand why. Probably because investor education has not reached the level where investors understand that this is actually a buyer's market, this is an entry point. And I would feel that between now and mid next year, when we get towards elections, it would be a good time to accumulate and hold for after the elections, because we have seen invariably that after elections and once we are back, the market usually bounces back, and this would be a time to reap benefits.
There's some diverse views when it comes to how to invest in the banks. Some saying going for the larger banks, others say perhaps go for niche banks like a NIC or Co-op. What are your thoughts on how to play the banking sector and get in there at these lows that we're seeing at this stage?
Well, we have three general characteristics in the banking sector. One is we have the up and coming, as you mentioned, NIC and say Co-op and probably NBK. And then we have the tier one, which are divided into the foreign, where we have foreign owned, where we have Barclays Bank and Standard Chartered, and then we have Kenya Commercial Bank and Equity Bank. Now what you'll notice is that usually when we are having an economy that is, or when we are having a market that is not very positive, you find that Barclays and Standard Chartered do quite well. But then they tend to chase growth when it comes to a very good and bullish economy, where we see Equity Bank and Kenya Commercial Bank and the locally owned banks doing very well. At the same time, the growth factor is always present, and so I would be looking towards taking positions on those locally owned banks, especially the tier one ones, and the smaller ones which are also tier one like NIC and NBK would also be good bets at the moment.
There are some concerns, though, going into the second half of the year, the impact of rising interest rates on banks and perhaps their loan default book. What are your thoughts on how the second half of the year is going to be for banks?
Well, I'm not particularly worried about the loan default book. I think we have continued to see loan books grow. We have continued to see very well managed loan books as well. But on the side of interest rates rising, we have seen banks get hit, especially on securities held for trading as interest rates rise, and this has been across the board. We saw Standard Chartered yesterday also blaming the same factor on the fact that the government securities book has actually suffered. But another thing you would have noticed with Standard Chartered, which I would like to point out, is that they have actually reduced their portfolio of government securities, and that is a pointer towards the fact that their bank is still quite confident in growing their loan book, and they're still feeling that lending to the public is still a way to go.
Let's move on to the cement makers now. Bamburi Cement, the most actively traded stock yesterday. That stock has fallen this month, but it's 8.3% retreat this year. That's significantly inside the overall indices, 20% plus retreat. Now, it's part of the Lafarge group. It had some impressive first half numbers, growth in net income, 27% to 441.9 million shillings. Many saying that cement makers are defensive in terms of the construction drive we're seeing in the region. Would you be buying into Bamburi at around, what, 165 shillings?
Well, Bamburi has been, is actually has lost quite a bit of their market share to new entrants and also to cheaper products on the market. That's because they actually sell their product at a premium because they say it is of superior quality. That said, the other thing is that we saw that a lot of the gains that they made were actually from foreign exchange or foreign deposits, exchange deposit gains. Now the thing is that they have diversified across the region by opening a new plant in Uganda, and I think that with now the pre-mixed cement business actually growing and the huge infrastructure deals that they have, Bamburi have a very good footing in that area, and I believe that their revenues are going to continue to grow. But then again, when we look at cheaper options on the market, I still feel that Bamburi is still a bit of a conservative company, and therefore I still feel more inclined to buy into, say, Athi River Mining, which is a more dynamic and a more diversified company in terms of product lines and revenue streams.
And of course, that company recently announcing plans to open up a factory here in South Africa. Thanks for joining us this morning. Samuel Gichohi, research analyst at NIC Securities from our studios over in Nairobi.